Hello, this is going to be the first of a series of videos about how to make a financial model for a solar project. Could be a rooftop solar project, could be a, a community rooftop, could be some big commercial establishment, could even be a big ground-mounted solar project. And in the United States, they give a very important and significant tax break to solar called the investment tax credit, which really kind of changes the whole structure, the contracts, uh, uh, the manner in which the models are made. This investment tax credit is 30%, at least in 2019, of the cost of the project, meaning that that's an enormous kind of financing. It really has a significant impact on the returns. Now, the problem with this thing called the investment tax credit, with it's just kind of a payment, so not a payment, but a direct a direct reduction in taxes, not a deduction for taxable income, a direct reduction. When you have this big investment tax credit, the developer making the project, there's some poor old stinky little company like me and I used to have a dog, not anymore. They're a little company like me. There's no way they need that big tax credit, so you got to get somebody big like Google or J.P. Morgan in there to be your partner to use the tax credit, and then it starts getting really complicated. I'm sure a lot of people watching this video already know all about this. So this video is going to be a first kind of video that discusses how this whole thing works, in particular in the context of a solar project. Now, you might say, why in the hell are you making this video? Other people try to charge you a bunch of money for these kind of models, and they all charge high consulting fees. And I'm old and I'm screwed up, and I say, what the crap? And I'm going to moan a lot about expensive lawyers, expensive tax accountants, and all this McKinsey and Deloitte, whatever. If you work for them, I'm sorry if I'm pissing you off. But I've been told here, and this is, I make these videos for cathartic kind of reasons, because I have this nephew who says, here's what he says. I got the wrong one. He says, I've never encountered a crazy thing like your mother and Edward. He's sending this to my son. Know that Edward, that's me, called my crazy by my mom on my deathbed. The abusive nature is staggering. They're both scum in a most literal sense. What the heck does that mean? If I ever get the tapes, I yelled at this guy. They go on tirades, and he's going to put these tapes. So if you see some tapes of me being abusive, I'm sorry. Okay. I'm sorry I said that, but it would be a lot more interesting to hear the story of my psychologist sister, who I can't deal with, than tax accountants. Okay, now let's get back to the model. Jesus, what I shouldn't have done that, but I don't care anymore. Old. I and nobody in the U.S. ever hires me anyway. The We start like all these other projects with project IRR, and I go crazy putting all of these IRRs. And one of the things we really want to do is see what the IRR is on a pre-tax basis. This is the SPV, or I'll call it the LLC. This is a partnership. This is a partnership that's owned by different parties, and you better make that kind of analysis first. And if you have a little bit of a higher profit on the partnership by having a lower IRR, a lower capital cost, or you go to Mr. Sun, and where did I put, though I didn't put a spinner box on the capacity factor. How could I have not done that? Or go to your offtake contract and make a PPA contract, you get a higher IRR. Then you want to see how it translates to the different parties. Okay, and you want to then reset all of this, I suppose. Okay, I'm going to when and I just made a video on oil, excuse me, and on that video I went through, or on that series of videos, I went through how to mechanically do some of these wonderful spinning boxes and everything else. But that's the place you should start any model, and I think that's fairly obvious. And then there can be a O&M contract and an EPC contractor. So I use these models now in the context of describing the kind of structure. Now, I didn't put this thing, the O&M contract could easily be this developer. And if you make profit on the O&M, that should be shown really in this kind of IRR. That's something I don't have in there yet. The EPC contractor could be the developer, and if you make a higher EPC profit, perhaps that should go into this, or one way or another. For me, those are some of the crucial kind of issues, and look at me being a hypocrite and not putting that in my model. Now, once you have this partnership built, then you start allocating it. And when you allocate it, you can allocate the income, which is taxable income, which is after the tax depreciation, and you in one manner, and there's something called a safe harbor. I should have made a little picture of a harbor in a island or a harbor, and it's a safe harbor, protection from whatever. I don't know why they're safe. Are they from warships or tsunamis or whatever? I don't know. They're safe. You're at the harbor. You're not going to sink the boat. And the IRS, the U.S. tax authority, says if you can take this party, Google or whoever, I should have put that here. They're allowed to get 99% of the income, which means they get all the tax benefits. But you can make this, and this is the key, you can make this income for one time period and then make a second time period where you don't get the income. And I'm clicking on this thing that says, I hope I'm clicking on this thing that says you can sell the asset after the one period from one party. This one would sell it to that one. And this is what happens when you sell the asset. Okay. Now, when you that there are a whole bunch of rules that allow you to be safe inside that harbor, and one of the rules is that you have to have 1% of the income going to one party, and you can go up to 99% to the other. Another rule is there has to be 5% in this partner. He has to have a real economic stake in the cash flow. He can't only be getting the tax benefits. So he has to get some of the cash flow, and then that means this partner gets the other one. And I'm trying to diagram some of this stuff off. Now, this all is fairly standard. In a solar project, you have something called a fixed flip, which means this is defined over a time period. And the tax authority says you have to flip it only after 6 years. That's all pretty standard. Now, once you have this partnership model and some of the income and cash flow going to this party and some of the income going to this party, that's where you begin. And this maybe is more about model structuring than about anything else. And I'm going to go into, I'm sorry, oh God, I don't know how many videos I'm going to have to make to go into some of the next things. Once you have that, well, you could put debt at the partnership level. So this debt, the debt holders, and I think we should get so more philosophical about whether debt is riskier than equity and have a real fundamental rethinking of some of these issues with what really is the risk of debt and equity. But that's beside the point, and I don't want to be on a tirade and all of that. This debt can be at the project level. And at the project, if it's at the project level, then these two investors only get paid after the debt is repaid, like any debt. And so when you make your partnership analysis first, you can then put some debt inside this partnership, really, and then equity is paid after that. And I call this project debt. And what you want to do is, instead of making your model put every stupid little day in this, the one I'm going to show you is an annual model at first. We can, of course, change it into a periodic model, but sometimes it's really good. It's really, really, really good to see how things work on an annual basis and not get confused by month by month by month and all this stuff. And that's what you see in this financial model and this periodic model. All right. The other thing you can do with the debt is, I should stop there. So once you do this, then you can compute the IRRs. The IRRs to the one investor and IRRs to the other. And you can see I'm obsessed with IRRs. And that's why anybody who uses ROI, oh God, it just pisses the hell out of me. See, I'm being abusive and going on a tirade like this son of my psychologist sister and my, oh God, says I do. But when you get a 67% IRR, which is what these tax investors get, these, oh my God. Oh, Jesus, I can't even fathom that. What they try to do is hide how much of the IRR they're getting. So they compute something called ROI, which simply sums up all the money they take out and money they put in and ignores that they're taking money out on the very first day and getting it all back within 3 months. Basically, everything except a little bit on the top. I'll explain that in a minute. All of their money back. Ugh. So, but I put IRRs all over the place. Now, another way to do this is you could take this partnership, give some of it to this one, some of it to this one, put no debt here, but then put all the debt down here, and that's called back leverage. And that debt is paid from the distributions of cash flow that these people get, and it's a very different kind of debt than this. Now, all that would be very simple, not very simple, complicated enough to just get all that modeled. The complicated part of this is not that. The complicated part of this, and how about is computing this stranded tax IRR if there was no stranded tax, and then after tax IRR with the fact that there's stranded tax. And notice, if I put this debt at the partnership level, I get a completely different answer. Okay, and if I use something called a deficit, it's called deficit reduction obligation or deficit, what the hell it's called. If I use that, I get a different IRR. I hope it's, hang on, let me do it like this. And I put a different DRO in. Okay, and I'm looking at having trouble. Screw it. The IRR isn't changing that much on this. Oh, there it changed a little bit. Now, I can also, there are a whole lot of tax, and I think the tax authority is trying to do is they're trying to say this party has to have economic substance. Did I say that correctly? In the transaction. So if you compute some accounting statistics, and the accounting statistics measure the net amount of capital they've put into the project, which is just equity capital. It's just an equity capital account with a series of different adjustments. If the equity account goes negative, that says they don't have economic substance in the transaction. You have to do all these kind of adjustments. I didn't talk about they get a preferred distribution, and these are all sorts of other kind of aspects of the transaction. Now, there is also the asset basis of these people, and if those assets go negative or are not positive, the tax authority says, no, 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 no. That's evidence that you do not have economic substance in this partnership. You're just in there only for the tax benefits, and we don't want to allow you to only be in there for the tax benefits because I don't know why. Whatever, they decided that. Okay? And so if when you make a financial model, the really difficult part is getting this. And see, when you have some of this, I call it stranded tax, and that depends on the transaction, and it depends on a host of other things. It depends on whether you sell the asset, and it depends on how you do your accounting. And some of this accounting I find so tricky. I'm having a tax accountant review this whole model, and I'm not finished with it. I'm not finished with the model. Now, let me just show you how you might negotiate this. Right now, I think, let's put project level debt in. I think it's just criminal giving them this kind of return, but okay. The way you define their investment, and I put their investment over here. Here's the amount they're putting into the transaction, and look at me as an idiot. I did not put what the ITC is. I should have put what the ITC is right now, but this investment is simply 15%. They're only putting 32% of the investment in, and they're getting 30% right back out. Oh my God, you can hardly. And so for that extra little 15%, they're getting all the tax benefits. They're getting this thing called a preferred return. They're allowed to sell the asset where you agree on an option, not a contract, because that's part of the safe harbor. Okay, they're getting all this for a little bitty 15% premium above the ITC. So if you say, no, let's be a little more fair, let's put this thing way up, and if we make them have more of an investment and they still get the same amount of cash flows and all that, then you can get this thing down. Okay, and then you can give the return back to you as the developer. Or better yet, oh, this is what I want more than anything else. This is my real tirade, Mr. Ethan. This is my real tirade, is that you could put a lower PPA rate in and get a lower bid from that PPA contract. And that's the kind of way you can use this model. That's the idea. Now, if you can get all of these tax parameters correct, all of the options for distributing the cash flow, all of the options for different kind of debt in, because if we put the other kind of debt in, it starts to look not so positive. So you've got to work with the bankers on that contract. You've got to work with all these contracts, and maybe again you want to take some money in from that contract. That illustrate. I haven't even looked at the model yet. Oh my God, I haven't even started with the model now. To compute this tax. Oh shit! What do I have here? I'll look at that later. God, well, that'll be in my second video anyway. Okay, I have a whole thing called a stranded tax diagram, which just looking at this should give you the willies. Okay, and what you do is you start with some. Pretend that this tax investor, hopefully I've got it here, they're just getting the regular old 20.98. And then what you have to do is, oh my God, you have to first compute this capital basis, this thing called the inside capital, which is how much capital have you invested in the project. And there are these absurd rules about exactly what you're allowed to put in it and what you're not allowed to put in it. Now, if this amount goes negative, here's what's supposed to happen. If that amount goes negative, this partner gets less taxable income and more taxable income and this one less. And they hate that because they're in this whole thing, whether they say it or not, to get the tax benefits. And if their taxable income goes up because of this account, these people's taxable income goes down. They don't really give a crap because they don't have any money anyway to pay taxes. Okay, then you have to pay it. And if you would have to reallocate that income because this account goes negative, your IRR would be only 4.34. And we can change some of the ratios and see what happens if we, well, I can't because I screwed up here, obviously. Shit. What did I do? Okay, forget that one for now. Did it change here? No. If I change it here, I'm gonna do this one. Excuse me, I'm fixing this. But again, you can give me all your thumbs down and get me crying as if I give a shit. And then you can, okay, oh God, we gotta get this artistic, huh? Which I can't seem to do. Oh no, it's a different size, and there's probably some way to make it the same size. So if I change this ratio, these kind of numbers change and these kind of numbers change, okay? But then you say, you're not finished. Then this famous deficit reduction obligation. I hope that's what I was calling it. Yes. And if these two people make a little side agreement and say, look, I'm going to have some kind of agreement where if my taxable income goes up and mine goes down, I'm gonna let you have a lower income and I'm gonna have a higher income. I don't know if that's a good way to describe this. And what you can do is, if you put some of this deficit reduction obligation in here, you can see you can take this IRR, and this IRR only goes down to 18%. Now, isn't this the way to try to make a model? I haven't looked at the model yet. I'm trying to get the model to explain these absurdly arcane kind of ideas. And then we're not finished, of course. Because once you've got this IRR, then you compute something called the asset basis. They call it the outside basis. And you have to understand what it does. And these accountants, they're great. Oh, man, they're great at computing all these and showing all these. And they suck at saying, what's the effect of this on the IRR? And what's the strategy that we should use? Should we put debt at the project level? Debt at the back leverage level? What's the risks to the different parties if we do that? And what are the tax effects? Now, after you do that, then there's this thing called, oh my God, they put some kind of numbers in it. I think it's called 731 here, 731A. And that's what they all shout about. Oh, 731A, blah, 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 blah. What that says, if you have paid more dividends in your cash flow, not your income, purely your dividends, if you have paid more dividends than your income, than your asset balance, than your asset balance, God damn it, then your asset balance, then you have to record a gain on that difference. And they call that some kind of deemed sale capital gain. What the heck? Whatever. It's comparing the dividends, and you should understand why the tax authority wants to do that just a little bit. The reason they want to do that is if you pay more dividends than your investment, they say you don't have an economic stake in the project. You just did this only to get out the tax benefits. And that, in this case, it doesn't really cause a problem. Now, if I do this other case, where it went from 25 down to 10 to 27, in this case, it reduced the IRR. I should almost have a little arrow for the IRRs, but I have too many arrows here anyway. And then once you've done that, you're still not finished, because this tax basis might be lower for other reasons, other than just paying some dividends. You might have a gigantic tax deduction, which is not part of the dividends, it's not part of the cash flow, and this tax deduction causes something called a suspended loss. Oh my God, the first time I saw this, I said, oh shit, do I really want to do all this? Ooh. And that thing, it's like a net operating loss carry forward. So you can get that money back. That's like a deferred item. But in this case, that causes a gigantic problem of 7.4. It pushes the return all the way down to 7.47. If you would lower the DRO, let's put almost a 0% DRO in, then the IRR goes down over here, but it doesn't go down. The IRR has gone down so much over here, it doesn't go over here. And can you see the interrelationships? And can you see the fact that if you have different kind of debt strategies, you can do this. Now, if you're outside the U.S., I suspect you've turned the video off a long, long time ago, unless you just want to hear me tirade it. Why would you want to do that anyway? But if I think this illustrates how can we make a good model presentation. So if you're outside the US and still torturing yourself by watching this video, I hope you're saying, how can I do this with my models when it gets a little complicated? Now, these diagrams all correspond. I have some inputs here. And we start the inputs with the operating analysis, and then we put some with the production and capacity and all this, and then we put some solar aspects into this, and then we just compute the taxes, forgetting all the distribution of the taxes to one party or the other. Then we put the assumptions only for the tax investor. Then we put the assumptions for the other guy who's the sponsor. And then once you put those assumptions in, you have to allocate the income and the profits differently. And finally, you can put some debt financing assumptions in. That's my suggestion on structuring the model. And then if you start moaning this is an annual model, please, oh God, don't be impressed if you're a young modeler who's not made, or if you're a student who's not seen all these monthly, semi-annual, quarterly models. Please don't ever be impressed. I'll do that later. We'll show you how this whole thing can be converted into one of these periodic models where you have a monthly construction and all that. But in the financial model, we kind of have the same structure, and I'm just going to stop the video in a minute, where we start with a partnership, see what the operation and maintenance is, and get this pre-tax IRR, which is a good little benchmark to use. And then you can choose to put the debt in the partnership or debt outside the partnership. You can also include a sale from one partner to the other later. And these should all be with little true and false, or ones and zeros, or yes and no's, or whatever. Okay, and then you can put the debt in the partnership, and then we get to the next stage, which is we get the income from the partnership, which is a big, big negative number. Okay, it's a big, big negative number until you run out of the depreciation, and then it switches to a positive number, which explains why you need to have these kind of flags up here for the switches. And I haven't even talked about generic macros for once. Oh my God. And then you have the assets of this yellow thing. So what we've done is just made a forecast for the yellow kind of thing. And then you go to the financial model, and after you've made the assets and liabilities, you go and see, well, oh, let's make a hypothetical calculation. Let's pretend that our company can use all of these investment tax credits. And by the way, this is a fixed flip. I've made some other wind analysis where it's called a yield-based flip. But if we can use this, and I think that's kind of an interesting thing to do, if we could use all of the tax benefits and would not have any of this rubbish about, oh God, who's getting what, and what are these inside bases and outside bases, this is the kind of return you're getting. And unless you, well, in this case, I said we can get it all, but if the tax investor wants more, the kind of weighted average of this return and this return couldn't be higher than that. I should have put this down, and maybe I should have put a little bit of a reset button somewhere. Okay. And where are we? And then we go down, and we compute the sorry. Then we start distributing the cash flow, and we distribute differently in the pre-flip than the post-flip period. Again, it's got a fixed payment date, and if you don't like the annual model and you say the flip date actually has to be in 6.5 years because of some safe harbor, remember your boat's in the harbor and you don't want it to go out and sink because the IRS is going to get all mad at you. You have to do it, I think, 6.5 years. Okay, and then you can put these, once you get all of this, you can distribute both. I'm sorry, I'm going a little kind of odd. That you distribute the partnership, that the blue, I think it was yellow, the yellow companies, you distribute their cash flow, and you distribute that cash flow to each of the partners, and they can be this thing called a preferred yield, that tax investors, if they don't get enough already, they demand to take money right off the top. And if you say, oh, that certainly sounds, if they're just getting a fixed return, this certainly sounds like they're in it only for the tax. Of course they are. Of course they are. What do you think? Do you think they really give a crap about the solar project and the profitability? They want the tax out. They want the ITC and the tax out. And they want a fixed kind of return. And then you can distribute the income. And the income is different than the cash flow. The cash flow is just your EBITDA minus maybe whatever you have, a little bit of other capex or something. The partnership in that they don't pay taxes at the partnership, by the way. I should have said that many times before. Then you can distribute the partnership income differently. Okay, and then you get down, and then you can put this buyout, which I'm going to make a separate video on. I wonder if anybody's would actually have the torture to want to watch this video. And then you start adding up all the cash flows, how much they get from taxes, how much they have to put in the project, and how much their IRR is. And that's I start with a tax investor, and then it gets hell. Then I put a reconciliation of the balance sheets together, and I compute this thing called the inside basis that I'm not even going to go through. And then you compute this, oh my God, look at this crap. I put the outside basis in, and then you finally, somewhere down here, get the IRR, not the ROI bullshit, the IRR that the tax investor gets after it's all said and done. And then once you've done that, you do the same thing for the sponsor. And then I put it all on one page, so I'll get yelled at by some of my friends, and maybe I'll have to go to a psychologist because I put the things on one page. Oh God! And then for now I'm finished with the video. All right, and then now we're gonna, obviously what I need to do to make my website a little more better and all that is to go through the really gory details of exactly how each of these things work.